If you enjoy this content, please take a moment to rate and review it. Your feedback will greatly impact our ability to reach more people. Thank you.
Okay, thanks everyone for joining. We have a guest speaker today, Doba Parushev he's the managing partner at Healthworx, which is a part of CareFirst. Doba, thanks for doing this. We're really excited to talk to you about it.
Vic, Marcus, thank you for having me. It's a pleasure to be here, and I look forward to the conversation.
Yeah, so I think most of the audience knows that Marcus and I are active venture capitalists. You are as well. Maybe give the audience a little bit of your background, kind of how you got to Healthworx and CareFirst, and then we'll dive into the investment strategy and how you work.
Absolutely. Very happy to. And transparently, my background is a series of fortunate incidents that got me here. So today I have the privilege of running the investment and innovation arm of CareFirst, which is a Blue Cross Blue Shield plan that mostly covers DC, Maryland, and Virginia. But before that, as the name and the accent give it away, I am not from around these parts. I was born in Eastern Europe and then took a long roundabout way to get here. Did mechanical engineering, of all things, in college, and then got tremendously lucky that my first job out of that was in a venture capital firm in Latin America. And I was young, stupid, I'm no longer young, right? And landed in a position that I didn't know actually existed, right? It's a tremendously privileged job to be in venture. And then the industry and the life swept me by. So since that beginning, I've been with McKinsey briefly as a consultant, did my master's degree, as many people do in our industry, and then finally landed in US investment with a firm called Edison Partners. So I spent about 4 years there with a wonderful team of people who transparently showed me the ropes of how to do kind of early but also growth stage investment in the US context. Transparently, right? I was a novice to this industry at the time. I think I came out a little bit smarter about it. I mostly did enterprise software, but also a little bit of healthcare. And then in 2020, had a tremendous opportunity in that CareFirst, again, based in Baltimore and in DC, was trying to structure their investment portfolio. So the company had been doing some LP investing, some direct investing, and fairly successfully over, at that point, probably a decade plus. But we're looking to a much more standardized process, bringing on a team, right, doing it quote unquote the right way. And I was lucky enough to get the mandate. So it's been 5 years. We've done a lot. We've built a lot. We look very different from what we did 5 years ago, and the adventure continues.
Yeah, excellent. That's a great summary. So I want to jump in to really help the audience understand the difference between a corporate VC, like you're managing there for CareFirst at Healthworx, compared to where you were previously, Edison Partners or the funds that Marcus and I manage. I think they're pretty different. I mean, of course, it's still the venture capital core industry, but there are some differences. How do you think about those differences?
I think you're being kind. There are tremendous differences between the two. And I believe in the value of both sides, right? But I think it's important to highlight that they're not the same. I'm going to argue that probably the more straightforward, certainly not easier part of the industry is the traditional or institutional VC. That is a kind of what you think when you say the words VC, what most people's mind goes to. It is technically a group of people, a fund, who goes out, collects capital for 10 plus years, right, from limited partners, folks who are looking for financial returns, takes that money, goes find promising, exciting visionaries, sometimes a little bit crazy companies, invests in them, right, helps them grow and expand and deliver, and eventually as those companies merge, get acquired, IPO, 10 plus years down the line, returns extra capital back to their investors, right? We know that space exceptionally well. And again, there's a ton of nuances in it and how it's done, the portfolio construction, the follow-on strategy, the thesis of different funds, what stage they invest in, but the mechanism is roughly the same. On the other side of this is corporate venture capital, right? Which I'm going to argue shares only the part of investing into companies and kind of gets a lot of creativity in the other parts of this process. One is the limited partner, so the person who provides the capital, the entity that provides the capital, is typically a corporation, right? Intel Capital, the capital comes from Intel. Qualcomm capital comes from Qualcomm, and so on, right? In the case of CareFirst, right, in Healthworx, the capital comes from CareFirst. So that is one difference. Of course, a lot of nuance how that happens. And therefore, while we play in a similar sandbox, we go on and look for interesting, relevant, promising companies to invest in, the outcomes are not purely financial. By virtue of investing on behalf of a corporation, that viewpoint, that lens of like what you're looking for can be very different. Certainly financial returns, but maybe M&A pipeline, right? Or industry insight and competitive intelligence, or ability to attract top-tier talent, or outsource some of your product development. A lot of very different ways to think about what corporations want. And I think that is where the biggest difference between the two categories lies.
Yeah, excellent. And what would you say the advantages either for the investor, you or CareFirst, or for someone seeking money from a venture capital firm? You could take it any direction you want. What are the advantages with a corporate VC as compared to a traditional VC?
Oh, perfectly fair. I think the investor part is kind of boring. I don't like talking about myself, right? What's probably more valuable to our audience is the folks, why does it matter to you if you're looking to either partner up with a corporate VC as an investor or to receive money from them, right, as a startup? And I think there's probably three big categories that are relevant here, right? I'm thinking traction, like network and branding, and probably insights. So traction is the most straightforward one, which is, if you're partnering with a large corporate investor, right, for example, us, you probably expected like we will work on things together. Maybe have a fast track to a pilot, a commercial arrangement, right? Some way of doing business, right? That flows to the bottom line. And I firmly believe that a dollar of revenue is more valuable than a dollar of investment, especially early on in a company's journey, right? And working with the right corporate partner, or a few of them, can get you there with much less effort, right? And much less pain, right? Compared to others. Underneath that, especially in healthcare, I think it's very true that the network matters, right? Being able to say we are partnering with CareFirst or with Optum or with Cigna or with CVS actually has a decent amount of signaling value and opens up networks and kind of connections and transparently a bit of a vouching validation. None of us really want to be first, right? In working with a new company that again accelerates the traction. And then the final piece that again I think is particularly special for healthcare is opens up the black box of the industry, right? As I look back to some of the more successful folks in this space, and again, Intel Capital comes to mind, they share a lot with the healthcare industry where, if you're designing semicon, right? If you're working on designing net new chips, et cetera, that's a relatively closed off industry with a lot of like black box know-how, with a fairly closely kept access to the industry. Very few people like stand up a net new company day one and not work with incumbents. And I think Healthworx works the same way, and therefore being able to navigate what matters to people, right? Which parts of your product are the most valuable, what's missing in the ecosystem, makes a material difference. So those are the big three, and transparently, those are the things that we talk about with our portfolio companies as the value we add.
Doba, can you talk a little bit about the expectations versus the reality of what it means to partner with a corporate VC? And I'll maybe go a little bit further there. You and I have not talked in detail about this, so I welcome hearing from you specifically about your experience. In my experience in partnering with different corporate VCs, there's a wide variety of the amount of influence that corporate VC actually has to advance to advance a portfolio company, even within their own enterprise. And a lot of times it has to do with sort of what the initial charter was for that corporate VC when it was set up. Sometimes they really are set up to be balance sheet and kind of be the scout outside of the building because they think that inside of the building it'll just get killed. Sometimes it's very much, the investment thesis is directly mainlined into the strategic plan for the organization, but they're not all the same. So can you talk a little bit about the expectation? Because I think a lot of times founders will have an expectation, if I get to work with this corporate VC, it means I can just, project, $1 or $2 million of net new business kind of coming through that channel.
Oh, I love this, and I'll be perhaps less kind to my colleagues and to myself. I am skeptical and suspicious of corporate VC investors, right? And I am one, which makes for a very paranoid daily experience. Right? But while I still stand by the tremendous amount of value that corporate VCs can and do add, I think you're exactly on point. There's a couple of innate challenges, or at least unique characteristic of corporate VCs that require a different approach than an institutional VC, right? To your point, I think there's a lot of heterogeneity in corporate VC. Different mandates, different structures, different sources of capital, different teams, etc. And transparently, having to understand why that partner is a good partner, why that corporate VC is a good partner for the company, and going into detail is worth the time. And transparently, each one is kind of unique. One other piece of this is going longitudinally. Corporate VCs change, right? You and Vic have a fund, that fund is raised, and generally for the next 10 years, that fund is kind of immutable, right? By and large, unless something horrible happens, that fund is there to invest in and support portfolio companies. Corporate VCs are subject to the vagaries of the market and of the corporation, right? Mandates change, right? Environments change, the mission of the companies may change, and so on, of the corporate parent. And therefore, while there's no purposeful volatility there, it ends up being a little bit more unpredictable. And to your point, right, like to hit the nail on the head, that means that once you're entering into an arrangement with a traditional institutional VC, you kind of probably know what to expect, right? You still should do your diligence, run some references, do all those good things. But by and large, you know what's happening. In the case of a corporate VC, one is, you need to do that, right? Understand why they are in the game. And then two is transparently work with them to make sure that there's a clear exchange of value, what you want, what we want, right? And codify in a way that survives over time. So that is my bias. I think personally, we've seen both, right? Especially in healthcare, I think it's very difficult to go without an incumbent, right? In a pure play disruptive fashion. By and large, it's a fragmented industry built on a lot of trust, and having somebody alongside you helps. At the same time, right, there's also horror stories of, your partner changing their tune, right, 1 to 3 years into the relationship and leaving you by yourself. So I hope that answers where you were going.
Yeah, and that sort of that feeds into that's really helpful to it. It feeds into the question I was going to follow up with, which is, how does your spot within CareFirst affect the investment strategy? So, like, I think we've talked before. I think there is a process for Healthworx to kind of learn about the corporate strategy at CareFirst and then sort of incorporate that. But maybe talk about that process of how you gather needs and priorities and keep that up to date on a quarter-to-quarter, a year-to-year basis.
That's a fantastic question. I think it's a great question that companies can ask their future investors, right? Because I think it will reveal a lot about how we think, how others think about this. So in our case, CareFirst is a not-for-profit payer, right? Which transparently makes my life fairly easy, right? We have a single stakeholder that is, on top of mind for us, which is our members. And at the end of the day, we have 3.5 million members we have the privilege of serving. Whatever I do, whatever we invest in, whatever we try to bring to bear, right, at CareFirst, kind of meets that greatest good for the greatest number of people when it comes down to their healthcare. So with that, right, like there's fairly little, ambiguity about who we are there for and what we're trying to achieve. And the question just becomes how, right? And I think, within that, I'm going to open back the old topic of, what are we optimizing for? Clearly, we are investing on behalf of our members. We need to be responsible stewards of capital. Financial returns do matter. But at the same time, we ran that math with the team the other day. Even if we became a top decile fund in the US and one of the highest performers, and all of our capital did fantastically well, the financial impact for our members is minimal, right? We're talking about like a couple of dollars per member per month, which as a member of CareFirst, I would gladly take, but I'm not sure I would particularly be grateful for that work. Where most of the effort goes about is fixing a lot of the friction we see in our healthcare system today, right? Care navigation, interoperability, reducing costs, etc. And that's where we work with CareFirst.
Yeah, excellent. And then as you think about creating value for the members, I think there are a couple maybe guiding principles, or I think they're called pillars. Maybe talk through the pillars at CareFirst and how does that feed into your investment strategy, if it does at all?
Yeah, no, it does, right? So the core values of CareFirst are around access to care, quality of care, equity, and affordability of care. And all of those are paramount, right? As you can imagine, where we sit today in US healthcare, there's a lot to be done across all four of those. I am going to argue that, like, while we hold them all near and dear to our hearts, right? And we have acted across all of them, at the end of the day, I have a little bit of a bias, which is looking at the affordability of care in the United States. That's becoming a material problem, and especially one that very much drives the rest of them. We still have very good outcomes in this country, right? If I get a horrible disease, there is nowhere else in the world I would rather be, because I think we have the professionals and the science and the resources to tackle it. But if those outcomes are becoming unaffordable, it makes them less valuable. Right. So this is probably the prime lens that affects the way we think about our investments. We see a lot of companies that are going to be successful in healthcare, right? They will grow, they will add value, they will sell and have good material returns, maybe even IPO. But at the end of the day, if they're not able to tackle a material chunk of the cost of care, they're probably not the right partners for us. The reason why we feel this way is, you and I both have seen the data, right? We spend, I would say, about the double of OECD average, right, on healthcare. We are not particularly healthcare. We don't have, lower disease incidence, right? We do not have something that justifies double the expenditure. And I'm an engineer by training. When I look at a system in which I put more money and I kind of get certainly not better results, it means there's waste in the system. Like, something's happening in there that's not quite right. And because of that, right, that's how we think about where we can most help our members, identifying those sources of waste, right, which can be both large and very visible, or a little bit smaller and more insidious, and trying to find the right partners to tackle them. So that's a big part of what we do. I think that ties back to your previous question of just how does that tie to CareFirst. I wish I could tell you that I have a 5-year plan that says, over the next 5 years, we're going to do these 7 things. The blunt reality is that it doesn't change that much, right? I'm a little bit, reminiscent and envious of my time at Edison Partners, right? Because one advantage of enterprise software investors is that the world actually moves, right? We have moved from mainframes to personal computing to the internet to mobile to cloud to now AI, right? So the challenge kind of changes and the times with it. In the case of healthcare, if you look back 50, 60, 80 years, it was still all interoperability. It was still value-based care. It was still chronic condition management. It was still member experience, right? The kind of fundamentals of what we've been trying to tackle don't really change. And therefore, our mandate, and to a large extent, like CareFirst's, plan, tends to focus on the same things. And we opportunistically go out and talk to as many people as possible, working with them, talking to them, right, exchanging ideas, and hoping that something hits at the right time for us.
And are you typically, it may not be a typical week, but are you typically meeting with stakeholders inside CareFirst in different divisions, hearing what they're struggling with or what their challenges are, and then turning to the innovators and founders and builders and looking to solve those problems? Or the inverse, where you find an exciting new thing and you go see if the corporate side wants it? Or is it kind of some of both? How do you think about the priority there?
Yeah, it's both. And I think it kind of has to be both, right? Now, that makes the job more difficult. I think I would have a much easier time, in my day.
If you could just take orders and go fill them.
First, and go and say, we need a new partner in nutrition, right? So we've seen both, and transparently, like, our portfolio is kind of half and half, right? Some of it is stuff that we know and have identified as a core need from CareFirst, right? And try to figure out who the best partners are. We often knew a lot of them. We add a few more, right? And try to help CareFirst find the best possible, collaborator in this. I think a decent chunk has been us going out and talking to people, again, who are thoughtful and driven and have a vision of how healthcare can and should be better. Because transparently, very often they come up with stuff that we do not come up with from inside the house. And then our role becomes reverse, right? Bringing them inside of CareFirst within the broader Blue family as well, and helping convince others, other executives, that this is something valuable we should go after.
Doba, do you invest on the administrative side or only on the medical side?
So we invest on both, right? That's a fantastic question, right? And when I say we are trying to squeeze waste out of healthcare, let's call a spade a spade. Like a double-digit percentage of that, right, is probably payers, right? We are a decent chunk of the administrative flow of this industry, and I would be lying to you if I said like everything is perfect and is about as optimized as it can be, right? So there's certainly opportunity to reduce cost and provide a better experience on the admin side. So we do both, and in fact, our portfolio has both. There's probably a bias towards the clinical care delivery side of the house, but also virtual, like that is a lot of where we see opportunity and a lot of the spend. But I'll flag one more thing there, which is if you think about just the core operations of a payer, a lot of it is plumbing is probably the word that comes to mind, right? And if you think about your plumber, right, you kind of have two modes. Either you don't really think of them because everything's going great, or you're really, really, really angry when something breaks. And therefore, I think the threshold to trying to innovate on the clinical side is a little bit lower, right? Whereas if we're going to try and replace a core system, right, with a better solution, right, but still that's being proven out, that's being built out and so on, not only is there more hesitation around it, but transparently, like, our own members' perception, right, is that is not exactly the pain point, right? And the risk of it breaking midway is not something they're looking forward to. So we have certainly tried, like, and we continue to operate in that space, but I'm going to argue like the bar is a little bit higher on that side to picking the right partner, because again, we need to get it right.
Maybe just a follow-up question on that. On the medical side, your sort of bias between, let's just say, tech-enabled services versus kind of a pure health IT that you could see maybe both you as the payer or maybe existing providers in your network using, like what generally gets more attention from you?
We probably see more of the former, right? Just by virtue of like what's out there in the market.
Yep.
I'm gonna say something that like we're going to like come back this 5 years from now, and I'll feel like an idiot for saying it. Right? But at least historically, healthcare has been human, right? Like at the end of the day, if I am interacting with the healthcare system, right, and that's more of a sick care phenomenon, but it is what it is. I am at my lowest. I need somebody to embrace me with, capability, right, with a degree of empathy and with a willingness to help me through me being sick, right, and get me to the other side. And that's been a uniquely human endeavor, right? And therefore, I think that more than any other place, healthcare is built for tech-enabled services. At the end of the day, I want the person I'm interacting with to be as tech-enabled as possible, as supported, not spend their time on stuff that adds little value or cause them to burn out. Like that is very, very important. But I think to a large extent, right, like I expect, at least today, that human to be a big part of the care delivery process, right? And I think because of that, right, those are the models that are most not only comfortable to implement, but like rational today, and we see a lot of them. That is not to disconnect the fact that like within all of this, US healthcare is unique in that it has way too many different stakeholders. Like if you just think about how you fill a prescription, right? The chain between the manufacturer to the supply chain, to the retail pharmacy, to the payer and their PBM, that whole thing, right, touches 5, 6, 7, 8 entities and God knows how many departments within them. And I think there are aspects there where bluntly software can play a very, very big role, and it should, because those are the places where, as opposed to people shuffling paper and printing things and scanning them again and so on, right, we can certainly build much, much more efficiency. But on the core piece, right, I am personally, and again, I'll eat my words in a few years, expected like when I show up to, my primary care practitioner, to my, cardiologist or whoever, right, whatever innovation is in there, it is quarterbacked by a human professional.
Yeah, excellent. I agree with that. So we'll both either be right or look stupid in the future. So,
my past history is not in my favor, Vic. So,
I'd be on the wrong side there. So, Healthworx has several different ways it goes to market. So I want to have you unpack that for the audience. You have 4 different types of investments, I believe. There's the starting at the most mature, Healthworx Ventures, which is sort of Series A or, a growing business. You have Healthworx Accelerator, which is probably pre-seed or seed, somewhere in that stage. You have Healthworx Studio, where Healthworx is actually co-founding in partnership with other founders. And then you're a limited partner, which is another way to go to market, where you're investing in funds. Talk about that portfolio of different even ways to invest and how it fits together in your mind, how it fits to sort of meet the mission for Healthworx, but also the larger mission for CareFirst.
Yeah, fantastic question. And I'm going to say, if anything, it's very evident we're function over form, right? If you ask me to design a healthcare investment vehicle, this is probably not what I would have come up with, like with a blank page of paper. But there's a reason why we do all of those things, right? And that is, going back to a previous point, I don't think we get to choose, right, the timing or the venue of innovation. By and large, right, while most of the capital is in our kind of Healthworx Ventures entity, which does Series A and B type investments, I am not looking for the best Series A company in oncology. I'm looking for the best possible solution that helps us tackle cancer. And in some cases, that one solution maybe is multiple ones spread across our LP portfolio. Maybe it's a direct investment. Maybe it's something just, behind the horizon. And we get to catch it either through that accelerator program or through the studio. So that is how we are thinking about it today. And the reality is, each one of those arms, while they work very closely together, have a slightly disparate mandate, slightly different, way of approaching things, a slightly different audience. So that is the structure. The funds and the ventures entities are probably the most classical ones. So to the extent you interact with a corporate VC, they probably have some version of that in different ratios, right, with different, history lengths, etc. But those are not uncommon. I think the accelerator gets a little bit unique, not terribly, right? And to us, that serves two purposes. One is being able to see a little bit what's coming, again, from behind the horizon, right? And that is very, very helpful. But more than anything else, a little bit of a social service, right? I think it's born out of empathy for the fact that you've seen this, we've seen this. Early stage companies usually are driven in healthcare by a clear vision to make things better. And that gets very quickly tempered by the kind of obstinate black box that healthcare is, right? Who should be working on this? What is the right business model? What is the core value, right? Like, are we even talking to the right people? Is that contract we're thinking about actually feasible? And the reality is, like, we have seen a lot of people spend a lot of time, effort, resources trying to answer those things. And in our estimates, it takes like between a year and a half to like navigate your way through the basics. So the accelerator is there transparently because we think we can condense it in a fairly efficient fashion. We do it together with Blue Cross Blue Shield of Alabama, with Highmark Health, and with LifeBridge Health, in which we put 20 companies per year through a curriculum. Think of it as a 2-year MPH light into 3 months that both answer some of those basic questions. Wait a second, how does credentialing work? Or, is value-based care actually a thing? Or like, does it mean multiple different things, and so on? And connects them with a bunch of folks who, transparently can be long-term friends and mentors, such that when you hit one of those walls, right, a year or two down the line, you have somebody to call and say, hey, listen, I just got this call from, I don't know, Elevance. I don't know what they're actually asking me. Can you help me decipher it, right? So that's the accelerator. And then the studio is perhaps the most unconventional piece of all of this, right? That I think there's very few other healthcare entities that run this model. It's born out of a view of a white space in healthcare. And in my mind, when I see white space in healthcare, it means somebody who needs help is not getting help, right? Not to mention there's opportunity to go and actually do something valuable. So that's our skunkworks, right? We go after areas where we think the problem has been poorly defined or poorly tackled, and try to build things de novo. It's by far the most riskiest, right, entity that we have. But you see it tackle kind of fundamental issues, right? We have a couple of endeavors in rural health, a problem that's very far from being solved. We have something in provider burnout and job satisfaction, massive issue. We have something in, ironically, one of the most recent stuff that we're working on is in pediatric care for foster children, so kids who are part of the foster care system, which transparently is a enormous problem that has kind of been buried underneath, right, our bigger narratives on both behavioral health and PCP. So these are types of stuff that we try to tackle then. Bluntly, if only a couple of those hit, I think I'm happy to retire on our legacy and say we did something good for the world. But they're also the ones that will take the most time to prove out.
Yeah. And I'm interested in, especially with the accelerator, but maybe the studio as well. Is there an opportunity to pull in some of the corporate leadership from CareFirst and sort of almost have a two-way educational where they're teaching the up-and-coming startups, but they're also learning about what's possible, what the capabilities are out there, and what's being thought of in this space. So you get kind of this double benefit for the overall organization.
Yeah, now you're exposing the risk. Like one of my colleagues is going to listen to this and expose our, benevolent, right, but certainly not obvious undercurrent, which is very much so, right? Again, for all the good that we do at CareFirst, it is still a large and sometimes bureaucratic organization, right? It comes with the territory, and I think that mutual exposure, right, of how you can try something, how it is okay to pivot if it doesn't work out the first 1 to 5 times, right? How you can quickly test and see if it's working, right? I think it's tremendously beneficial. And transparently, we have had our executives at CareFirst serve as mentors and supporters across our portfolio. Very much we believe that the bulk of the value is transferred from CareFirst towards the outside, as in we're helping those companies succeed. But that, cultural benefit, right, organizational benefit is certainly there. And I think it's helping us not only be more open-minded about integrating new solutions, seeking different, ways to do things, but even in our day-to-day work, just being a little bit more agile.
Yeah. I mean, I think certainly there's a lot of value that comes from CareFirst to the entrepreneurial community, but I also think there's a lot of value in the empathy that both sides get from each other. That there are many existing systems, procedures, practices in the corporate CareFirst that there's a reason they're in place, and that people. There's negative health benefits or dangerous things, or there are reasons that if the entrepreneurs can get empathy for that, they can now understand much better the challenge, and then vice versa too. The corporate leaders can get empathy with what these kind of crazy founders are trying to do in a way that's helpful for them too.
Yeah, you're perfectly right. I think, again, you're pulling the curtain all the way back, which I think is perfectly fair, right? At the end of the day, the current convening venues, which is usually a sales pitch, right, can be a little bit standoffish, right? I, as a operator, am talking to the 15th company of the day trying to sell me something, right? The company itself is trying to explain why they're doing something good for the world and hitting a brick wall. And, being able to create that convening venue, just like a different conversation, we can, glean and understand, that's what you're actually trying to achieve. Or conversely, this is why these processes exist, because first of all, do no harm, right? Is important. So again, it's not, I'm going to argue, the core purpose of doing this, but is it a very cognizant and very positive externality? Absolutely.
Doba, quick question about venture, because you have a background beyond corporate VC. You worked at a great firm in Edison. The venture capital industry has certainly seen better days. The last 3 years have been, fairly tough, and a lot of capital has been concentrated into sort of mega AI deals. And then even Vic and I were looking a few months back. We were looking at sort of publicly traded healthcare stocks, and really over the last 2 years, it's basically been flat. So actually, last year was the worst performing sector in the S&P from an industrial sector perspective. I'm just wondering, with CareFirst and Healthworx having this primary focus on the members, and with the financials not necessarily being a significant part of moving the needle, but still your portfolio companies, right, are almost certainly invested in by traditional venture firms. How does a moment where there's been less liquidity, less exits, capital is harder to come by for follow-on rounds, how has that impacted your work at Healthworx, and just generally speaking, does it change the strategy that Healthworx and CareFirst has around innovation from the venture perspective?
This will sound a little bit odd, right? I completely recognize what you're saying, right? And I think there's a broad conversation to be had about the fact that, in many cases, we will see a number of very promising and very valuable and very impactful companies not make it, not because they did something wrong, not because their VCs did something wrong, but because VCs still subject to like those massive cycles, right? And we caught one. All right. And we overcapitalized a number of companies. And transparently, we funded way too many companies as a cohort. And when typically there would be 5, 6, 8 companies tackling the issues in, let's say, maternity, right? There were now 50 competing for the same number of pilots, same number of contract dollars, and so on. And at some point of time like that, I my heart goes out to the people who are caught in this, right? This is a bit of a macroeconomic situation where the LP capital was there, GP had to deploy it, right? And at the end of the day, as a company who believed that they're building something valuable, and often were, you took it and just the tide swept you away. So that is one part of the answer. I think on the other side of this is, I'm a little bit more cynical, and I'll say something again that probably will get me in trouble, but I am not convinced that plug and play venture capital, like copy paste from technology into healthcare, works.
Mm-hmm.
And to use your market example, right? If I moved you back to the 1990s, early, just before like the dot-com boom, right? Like you have 35 years to come, and you have full knowledge of what's going to happen. And I say, hey, Marcus, you want to invest in some tech companies? You don't need to even open like your notes, right? You know that as long as you back Apple and Microsoft and Oracle and Google, right? And like 7 others that we can reset out of our heads, right? You will be investing in groundbreaking, like staple type innovation that disrupts the market and becomes the next big thing, right? That has not really been the case in healthcare. Now, I'm going to carve out life sciences, right? Truly, CRISPR has made a big difference, mRNA has made a big difference, and so on, right? But on the care delivery, digital health, tech-enabled services side of the house, I am not convinced that we have, well, certainly we have not, and I'm not sure that we will have that type of disruption, right? It's an industry that is, based on legacy incumbents. It is fundamentally built on trust. And then at the end of the day, if you want to build something, you probably have to work with the system, trying to change it, as opposed to completely disrupt it. And I think this is where the two narratives come head on. The venture model in technology, like pure play tech enterprise software, depends on wholesale disruption. Go build the next multi-billion-dollar business that does everything better, and it just becomes the dominant incumbent for a while. That does not happen in healthcare. And therefore, I think, we are better served by a mental model in which we invest in companies that have a more reasonable expectation of what they're doing, work well with this ecosystem, are adding tangible value and are fully anchored in that value, right? And don't get over their skis. And, I'm bringing this all the way back that this is what our portfolio has looked like for the past 5 years. I won't lie to you, in 2022, 2023, it was an anxious period because we were very much contrarian to what the market was doing. Massive valuation. Each company was going to be a multi-billion-dollar business, disrupt the status quo, and so on. Today, our portfolio hasn't really felt it, right? We've had next to no down rounds in our portfolio, maybe 1 or 2 out of 15. Most companies are up and to the right, but again, because they were built on fundamental value, and that is the concern I have. Again, that makes me look, semi-smart today. The moment the cycle picks up again, I probably won't look anywhere near as smart. But I think fundamentally in healthcare, outside of life sciences, again, that we probably need to be a little bit more value-oriented, right? And not only are we seeing the AI stuff, I'm sure you've seen in your pipeline, we've seen it, there's been a good few 50x, 70x, 100x revenue deals in our pipeline over the past couple of years, so they haven't gone away. And they still depend on massive outcomes.
Yeah.
Which work.
Doba, do you think, is there a difference in, is it product versus process innovation that is part of what you're talking about, in the difference between like traditional venture, consumer tech venture or something, and healthcare? Or is it different, that more like is regulation and life's at stake in healthcare, so it's slower. Or maybe it could be both end.
I'm not sure about, I think the former is right. I haven't thought about it in that lens, right? So I'll probably need to reflect on it. The latter certainly is true, right? I think there's two big things that make healthcare investing special, right? One is the stakes are much different. Move fast and break things is a fantastic motto if you're building a social network, a new database, a smart toaster, right? Like if I get amazing morning waffles and like 1 out of 10 times they come out soggy, I can probably live with that until we iron out the kinks. Like that is fine. If I have to go to my cardiologist, proctologist, whoever, right, and like 1 out of 10 times they make a mistake, that's my health and life on the line, and I don't think that's okay, right? So I think you're perfectly right on that layer, but that also has a question of trust, and I think that's what empowers the network of incumbents today, of which, to be fair, CareFirst is one. I'm on a CareFirst plan, right, as a member. If you gave me all the options in the world and had me choose between CareFirst and a newfangled upstart out of Miami who has a great plan, but literally is just figuring it out, I will probably still pick CareFirst, right? We're about to welcome our second daughter in a couple of weeks. She's getting delivered in a Johns Hopkins facility, which I think is great. And transparently, however, if you came to me and said, hey, we have these new startups, babies yet, but you should try it, I would be very hesitant. You put those two things together, and I think that makes it very difficult to take the tech model and reapply it here. But I'll think on the product aspect too, because I'm sure there's a material factor as well.
Okay, excellent. Do you have an example or a case study that could sort of pull these things together? Maybe a company that you found to address an issue that CareFirst was looking for, or the inverse, where you found a company and matched it to a division there?
I do. I think it's going to be a counterexample in that you know how I mentioned that corporate VCs are very disparate, right? We're disparate inside the house as well, right? So no two of our companies have actually taken the same path. I'll give you two quick examples, right? One on each end. On the CareFirst needs piece, right? Starting in 2020, we were tracking the NEMT space. I think that was, a number of companies founded between 2015 and 2018 were making progress. And, I'm remembering like Roundtrip and CareCar and Kaizen and Veyo and SafeRide. And, very much a value add space, relatively important, especially as government programs was picking up, right? Medicaid and Medicare. And something that we thought could deliver a lot of impact to our members, but more broadly to US healthcare. We just couldn't figure out, right? Who the right horse is, right? Where's the differentiation? So we actually ran that scan. We didn't do anything with it. A few months later, coincidentally, CareFirst was looking for a provider in this. They had been working with circulation for a while, right? That was not meeting the needs of our growing population, right? So we came up and said, hey, listen, we know all the people in the space. We'll put you in front of all of them to make your decision. And we think we have some notes of who the 2-3 top ones might be, right? So out of that, SafeRide, who had been talking to at this point for probably a couple of years, right, got a relationship with CareFirst, got a contract. We were still not certain, we thought it would be a great service provider for us. We weren't certain it would be the right investment. So in, I believe, October of 22, they rolled out with CareFirst and started providing services to us. And by October of 23, not only were we seeing kind of inside how this was working and working very well, but also the company was beginning to peel off in a kind of a tangential way from the competition, more infrastructure play, etc. Right? And at that point, we pulled the trigger. So it was one of those when CareFirst was looking for something, we took our time, we helped them find the right partner, and then subsequently invested. We've done it in reverse. So with Culina Health, we were scanning the marketplace for ways to provide more ancillary support around care delivery, right? And it's a very, very big topic, right? And came up with the idea that RDNs, right, as a capability, right, as clinical training, as level of empathy, as ability to engage with members and with patients is actually a pretty interesting way to support chronically ill populations. So that's why we met Culina. And then we thought we made a good choice, and that's playing out well. We brought Culina back into CareFirst, right? And tried to convince our team that this is a good bet to have. lo and behold, about a year after investment, not only was credentialed in our network, but also they became the exclusive nutrition provider for our entire population that uses our virtual primary care platform. So if you dial into CareFirst through telemedicine, and if you need nutrition, it goes to Kulina. So we've done it both ways. Not a singular path, and I think that's also the fact that like each company kind of comes at the problem in a different way.
Excellent. I might want to close with us talking through some kind of advice and framed as mistakes that our audience could avoid. So if there are large enterprises that are considering getting into sort of corporate venture, or they want to dip their toe in or start thinking about these ways to do R&D in a different way, what's the biggest mistake that they should try to avoid?
It's probably the same for each side, right? But like it's only for enterprises, and what we've tried to avoid as a corporate institutional investor, like I imagine I'm paranoid about our own work, right? Is to try to be very clear what we can and cannot do, and like almost reach a tacit agreement with our investments before we ink that page, before we say, here's the money, right? Let's do this. So there's no surprises, right? But I think what corporations kind of tend to get wrong when they try to get into this is going into corporate venturing without a long-term plan, right? I think the easiest thing in the world is to go write a check into a startup, right? Like between us, we can probably do a reasonable job in like no time. What happens afterwards, right? Why you wrote that investment? What are you in for? How are you going to support that company? Where does the capital come from? Do you have follow-on resources?
Yeah. How will you know if it worked like you want or not? I mean,
exactly.
Yeah.
Right. So all of those are things that like are a little bit boring, right? And a little bit like, work and things you have to put in advance, and often get skipped, right? And I think it doesn't come back to bite you right away, but certainly right within a couple of years, you start feeling the pain. And I think that's probably been a big challenge, and one of the reasons why corporate VCs have a little bit more of a mixed track record in terms of longevity and survivability compared to others, right? I'm going to argue they're actually harder to execute than institutional VCs, right? None of the job is, harder. I think they're both very hard jobs. But at the end of the day, right, the simplicity of like, we're just here to make sure we do appropriate capital allocation and help our companies different ways to get there. Like it's much more broader. So that is one piece. And I think a corollary to this is corporates overestimate, or at least don't consider, their own ability to work with early stage startups. And that's like something that like, we were thoughtful about, and I'm not sure we fully got right from the get-go. So we had to optimize it, right? We can work very, very well, let's say, with our ventures companies, right? They tend to be, typically around $5 million plus of revenue, right? And like a little bit more mature and all those good things. And it's not a plug and play, but the process exists, right?
Yeah, they have resources, they have an operating team. There are people there for your team to engage with.
Exactly. And kind of, meet the process theatrics. They have insurance, right? There's a designated counterparty, et cetera, right?
Yeah.
Whereas, sometimes in our sector, and even those like have some early contracts, but it becomes more dicey because if it's two guys in the garage, right? We are not always well instrumented to strike a contract with them. And I think that has been one learning where, many organizations jump into it because innovation is the right thing, right? It is good to talk to others and bring their ideas in-house and so on. And suddenly you realize that, and I'll give a real example, your corporate procurement team has a $10 million minimum cybersecurity policy. That's a problem if you're a startup, right? The vast majority of them don't have that. And suddenly you have to scramble and figure out like which way to give and how to optimize this. And it's certainly it's not the only thing that gets in the way. So those are two things. Like one is the general purpose and structure of the investment vehicle. And then two is the corporation's readiness to engage with earlier stage companies.
Yeah. Okay. And then flip to the other side. If there's an entrepreneur listening that wants to approach a corporate VC, what's the biggest mistake that they make when coming to a Healthworx or other corporate VCs?
I think it's the same one, right? I think it's, letting the corporate VC get over their skis, right? And I would frame this less as a warning, but as advice. Understanding what that corporate entity is trying to achieve, why they're talking to you, why they're in the game in the first place, right? And ideally, what's the give-get here, right? What are they expecting out of us as a company? And conversely, what we, the company, can give to them, right? I think is critical. And sometimes there's just not enough time. Sometimes you don't want to upset a prospective customer. Sometimes you just conflate institutional and corporate VC. There's a number of reasons like why those conversations don't happen. But I'll be perfectly honest, like I don't think we've ever had a bad conversation of that type, whether we've prompted it or the entrepreneur themselves have come and asked us about this, because it sets the stakes, right? And once you know what each party wants, if this is a good idea, it's going to work out just fine. Or transparently, sometimes you just get out of Dodge, right? You realize it's not going to be a good fit and, move on.
Excellent. Anything else you have?
Yeah, maybe one last question. I think that outsiders and even myself sometimes may be a little bit puzzled when they'll see, usually around the Series B level, a whole bunch of different payer corporate VCs invested in the same deal.
Mm-hmm.
That happens. And I would love to just sort of hear from a payer corporate VC, what's going on there, right? Like what's happening when, you could maybe sit down with a CVS or a United or whatever and sit at the same table and stroke a check together. What's sort of the thinking there? Is this sort of a demonstration that this company can advance healthcare for the entire country, and so everybody wants to be in on it?
Kind of. And I think we've been seeing more of this, and honestly, I don't think we're seeing enough of it, right? As in the positive and the negative, right? In the positive, the reality is that, if I am Healthworx representing CareFirst, and I think I'm going to discover this unique asset that only I will know about, and it will be miraculous for my members, and they shouldn't work with anybody else, that is insane, right? That is like not only, unfeasible, it's also deeply problematic, right? Like at the end of the day, I truly care about improving, let's say, oncology outcomes for the US population, like for all of our fellow citizens, not for the members of CareFirst. Ideally, first for the members of CareFirst, as cheaply as possible for the members of CareFirst, right? But like, we're not trying to keep things, contained. And I think to that end, right, while we are competitive commercially, right, with CVS and with United and with so on, right, and I'm happy we're competitive. I very much believe in like free market competition. I think on certain parts of what we do, we have to see it the same way, which is we do want our members to be healthier, right? We do want better outcomes. We do want lower costs. So between you and I prefer that outcome. The negative version of this is we've seen the opposite. So if you remember kind of 2021, 2022, there was a bunch of MSK companies and every single corporate VC picked theirs, right? I don't know if that bodes well either. Now, they were available. They were all good in their own right,
sure,
etc. Everybody was picking a winner, right? But that creates a degree of entrenchment because everybody had the same idea. Well, I'm going to pick this one. And I'm going to call all of my friends and other payers, providers, etc., and tell them how great my bet is, and they should follow on to my bet, right? And of course, that didn't exactly work out, right? And therefore, I'm actually happy and excited to see more collaboration on that front, while maintaining very hefty competition commercially, right? Then bluntly, see entrenchment and people saying we back this and we believe in it, and like, come here or high water, we're not going to switch to somebody who's better. Like that is, I think that's irrational. And something I tell my own team, which is we love, right, and support and back our portfolio companies. They also need to perform. And if at some point in time, somebody overtakes them, right, and delivers better value for our members, we're probably going to have a difficult conversation.
Thanks for that. That was helpful. We've talked about this on the show before.
Yeah.
It's just helpful to sort of hear one payer
CV
perspective. So thanks.
We're idiosyncratic, but that was a fairly straightforward one. I'm sure there are many other things like from the outside look very, very, very strange.
Yeah.
Right?
Well, and it's
interesting.
interesting.
There's some logic behind them.
I think this is right, but let me just ask it. It's more of a strategic goal for Healthworx with a financial outcome as well for the CareFirst overall than like a traditional VC, which is really financial performance. And then if I can help society, I want to help society. So that I think can lead to more collaboration with other corporate VCs that have similar strategic goals. I think that's right.
I think it's perfectly fair. No, I would not pretend and say that, like, I have an inside track of what the mandate is of my peers, right? As I mentioned, one of the massive advantages to me of working for CareFirst is single mandate, right? We're there to serve our members. If I also had to worry about earnings per share or like quarterly reports and so on, like that might add some more nuance of just how much capital to deploy, right? What returns you expect and so on. So I think in each and every case, that mandate is going to be a little bit different, even within the strategics, right? Do not assume there's like a mold that people come out from. But I think that's perfectly right. By and large, I think across the universe, and that's not just healthcare, right? Usually the strategic impact should eclipse the economic one.
Yeah.
Awesome.
Okay. Where can people find more or follow you? Maybe on LinkedIn or website, maybe point some people to where they can go learn more about Healthworx.
I think they've had more than enough of Healthworx, but if they're looking for punishment, Googling Healthworx will get you there.
Okay.
That's Health, WORX.
Yeah, and I'll put it in the show notes so people can find it easily. So the website is the best place to go learn more. Is that right?
The website is the best place to go to. And as you can imagine, we are, as usual, in the middle of a revamping of our visual image. So bear with us.
Yeah, it'll look better tomorrow.
Every single day.
Okay, Doba, thanks for your time. Really appreciate it. This was great.
Gents, truly a pleasure. Thank you for having me. And until soon.
Thanks, Doba.
Thanks.